So one of the more common questions I get asked here on YouTube is, what is my process when I come to picking and buying a stock? And a further question, how the hell do you know how much to invest in the stock you're actually buying? Should you YOLO in with leverage? Should you go all in, or should you just patiently buy in? Well, if you're sat there wondering what is this good looking guy with a beard's process, then I'm going to break it down for you with the exact formula I use. 5 very simple steps that I use to process information and determine how much I should allocate and invest into any stock. And it's actually really simple, but I want to stress each of these points could be broken down into an individual video itself. So if you want that to happen and you want me to go ahead and break it down even further, let me know down in the comments at the end of this video and I'll try my hardest, if there's enough people interested, to make sure that happens. Now, the whole goal of this video is to help somebody out there, somebody who is new to investing, somebody who's struggling with investing, to find their own process. You don't need to go and copy mine, but hopefully by me sharing my process, it will help someone establish their own. Because believe it or not, I actually do have a process. I don't go on Reddit, look at a picture of a moon and throw out a diamond emoji and then go and buy a stock that this post told me to buy. I actually have a process in a set order, and this order and this process, these 5 simple steps, help me determine how much I should invest into this stock, or if I should invest in it at all. Now, the first step to all of this, of course, is smashing the living socks out the like button. Seriously, it's been proven now by the Flat Earth Space Society that smashing the like button will massively improve your chances of becoming the next Warren Buffett. What have you got to lose? Make sure that like button is turned blue. And without further ado, let's get on to the first step. Now, we are going to assume that we have found a stock, we've got a scanner, we found it on Reddit, we found it on Bloomberg News, or maybe Gary down the pub just said, look at this stock, it's going to the moon, and we are now researching it. If you do want a video on how to scan and search for stocks, again, I can make that happen. Let me know down in the comments. But for this purposes, we're going to assume we have already got a stock and we are looking at it very closely. And that said, if you do have a stock, pull up a chart, pull up the fundamentals, and we can have a look and run through it step by step. And you can come back to this video as a reference, hopefully helping you build your own process. But the first step is the fundamentals. And yes, I know fundamentals, smundamentals, which literally nobody on the internet says, but a lot of people do say fundamentals are irrelevant on this stock. People who buy into AMC, the fundamentals do not matter, and it could not be further from the truth if you want to have long-term success in the stock market. This is the first step. And what fundamentals count and matter to me? Well, fundamentals literally are anything really to do with the company. Other than news, it's anything that is factual, their earnings, their float, their financial health, what the company does even could arguably be fundamentals, but reality is fundamentals, it's a massive part of the company, and it's a big sort of overcrowded space of information that a lot of people tend to just skip by and would rather focus on the fact that NIO is going to sell 1 million cars every month in the next 10 years. But for me, missing out on this fact is actually a big mistake. This is a sort of good way of screening out some bad stocks that you don't want to waste your time on. Because really the whole point of having a process is to weed out stocks early on that you don't want to fully research. It's a point of sort of saying, look, I like this company, but it doesn't fit here, here, and here, and then throwing it out the window and never looking at it again. Because at the end of the day, our time is very precious, and this is why the process is so important. Yes, we might miss out on the odd stock that goes to the moon, but the simple fact of the matter is there's millions of stocks out there, and there's definitely dozens of them that are worth a buy right now. So yes, you are going to miss the odd moon play, but you are going to find a lot of decent companies, and more importantly than that, not waste your time and money. So when it comes to fundamentals, the first thing I look at is what is their operating revenue? How much money is coming in the company on an annual basis? I tend to look at as long as possible time periods, ideally 5 to 10 years. Of course, if it's a newer company, then you've got to sort of play around with it a little bit. But what we are looking for here is, are their operational revenues steady? Are they pretty much the same every year? Are they growing? Or worst case scenario, are they falling? Now, of course, if a company's revenues are falling, it doesn't mean it's a bad company to invest in. I mean, we could say, look at the oil players over the last couple of years. When the whole Miley Cyrus happened, oil companies' revenues just went all the way down. But we do know they're going to go back up. And at that point in the time, companies like BP, companies that I bought heavily into, of course, had a lot of benefits. So it's just the first sort of criteria to look into. If their revenues are falling down, Why? Is it justified and is it logical? That's the first sort of thing I look at. If their revenues are going up at a decent rate, that growth is good, we need to look further. If their revenues are steady, do you want to invest into a company that is not really growing? Maybe it's a dividend company and that's what you're looking for. And if that's the case, we move on to the next part of the fundamentals, which is dilution. Diluting on any company, no matter who tells you this, is not good for the shareholders. Let me put it very basic for you. Let's say you buy 100 shares of a company at $1, and then instantaneously after you buy it, they double their float. They had 1 million shares when you bought in, now they have 2 million. Guess what? You now have 50% of your initial capital because it's simple supply and demand. As a company sells more shares at the market, it needs more buyers to keep it at the same price. Your simple shares are losing value the more they dilute. It's very basic. So that is not necessarily a good thing. But a lot of companies, especially in the growth sector, do need to dilute. Companies, again, like NIO, need to dilute to build these mega, giga, whatever they're called, factories, so that they can sell 1 million cars a week, or whatever the crazy number is in my latest video. But the simple point is some companies do actually need to dilute, and companies like AMC, who did dilute recently, if they didn't dilute, they'd be bankrupt. So dilution is a way of keeping the company alive, but as a shareholder, it tends not to really be a good sign. So again, over the 5-10 year period, I look at the share count over the years and is it increasing or decreasing over time? Because in reverse terms, if the share count is decreasing and the company is buying back shares, well then my shares are actually going to be worth a hell of a lot more because of simple supply and demand. Let me put it another way. If we have 1 million shares in a company or 100 million shares in a company, which is easier to move to the upside? Of course, it's the million shares because you only need to move 1 million shares. With 100 million, it's a lot harder. You need a lot more buyers and a lot more volume. So it is a big factor, and what I tend to look for here is they are not diluting too much, and if they are, is it justified? And of course, if the share count is going down and it's the opposite direction, then that's actually a really bullish factor and something I tend to love. This is very overlooked and I think a very important part when it comes to looking at the fundamentals of any company. Now, one of the most important factors that I think is really overlooked right now is the PE ratio, the price to earnings ratio. Because we live in a market where everything is crazily priced, we've seen Tesla with like literally ridiculous PEs of like 300, 400, maybe even 1,000. I can't remember what the absurd number is. Then it is sort of accepted that PE ratios don't matter anymore. Historically speaking, a PE ratio of 10 to 20 is not that bad depending on the company. But right now, we're paying a massive premium for a PE. So a price to earnings ratio, in very basic terms, the closer to 1 in theory, the better value a company is. Now again, I wouldn't buy or not buy a stock on any one of these said factors, but it is important to note that a high PE may mean that the stock is very overvalued. And the last part of the first step of fundamentals is the financial health. I have a subscription at Simply Wall Street. I'm not affiliated there and I think it's very worthwhile doing. I don't know how much it is a year, I'll put it on screen now, but there they put it very simple. You don't need to go in the filings. You can see the financial health of the company, long-term and short-term, and make a decision. If the company is in very poor financial health, where their liabilities massively outweigh their assets, then that might be a company I don't really want to invest in, because again, they may need to raise capital via dilution, and that could mean a big bad thing, or they go and get loans, and it's just something you really need to look at. Is the company in good financial health, both long and short term? Now, before moving on to step 2, which I think is the most important step, and this step, if it doesn't look good, I genuinely not move on at all with this stock at this point. But before we move on, there's a new feature on my Patreon. If you want to support the channel, you can go and check out Patreon down in the description. Every single month we're going to be live. We're going to share a link just with Patreons at any level, and you can come in there, we can chat. We're going to have a beer on a Friday and we can go through these steps in process, and I'll individually review any stock that any of my Patreons want to go through. So if that floats your boat, go and check out Patreon in the description. And now we move on to step 2, free cash flow. At this point, the stock has made it through our fundamental filter and we're still in fundamentals. But this is the most important aspect, free cash flow. How much free cash flow does this company have at the end of every quarter or every year? Now, what I want to look for here is more on an annual basis. But again, if it's a recent company, I can go quarter by quarter, and I'm trying to find out how much cash after its operations, after its revenues, the end figure, how much does this company have free left over to either buy back shares, give a dividend, or invest into a new project, or maybe even buy out a company. What is their free cash flow, and is it increasing? If I see this free cash flow increasing, it's a very good sign, because it means that at some point they're going to have to do something with it. They're not going to keep it in a bank earning next to nothing. They're going to reinvest it somehow, again, whether that's buying a company, investing into a new project, buying back shares, or offering a dividend. All outcomes are good, but again, the other side, if you see the free cash flow declining, this could warrant that the company is maybe overstretching, and it could be a problem long term. But again, it's not an exact science, because we've seen legitimate good companies' free cash flow go down over the Miley Cyrus. So if you do see a big dip, it doesn't really mean the company is definitely not a buy. You just need to understand, why did it go down, and will it recover in the future? Again, going to the BP example, it declined because no one was using oil, no one was driving, no one was going on planes. So of course, oil took a massive hit. But will it recover? Absolutely. Therefore, the free cash flow could come back. We find the average. Is it growing? Yes, it is. Let's move on. So some of you ape Reddits will be happy to know we're done with the fundamentals. We're now moving on to step 3, which is market conditions, risk, and news. Now, this is very important. If we're looking at a stock, and let's say it's BP again, we need to see what the market condition is. Is oil going to have a big fall in the next coming years? Is BP's news good? What the future projects are? Is there going to be a second lockdown? We need to know these risks. But the big thing I want to stress here is, don't look at the good news, look at the bad news. I really want to stress this home. Think worst case scenario, what can affect this company? Then look at the good stuff, and then go back to the bad stuff. That's how I do it. Your whole point of this process is to be as biased as possible as you can, because you have worked hard for your money, and you should make sure you put it somewhere where they're going to work hard for you. So you really need to be as hard as you can on these companies, and this is where it comes down to making sure you've got the right stock with the right fundamentals, with the right market conditions, and more importantly than that, they have future prospects that could grow. But if they don't grow, what is the backup plan for this company? So for example, BP's moving into energy, renewable energy I'm talking about. If BP doesn't go into renewable energy, then my plan doesn't fall by the wayside, because they're still doing oil. So there is a fallback plan, and I'm not really at risk of losing all my money. I'm getting a dividend along the way while I wait, and that is sort of my thought process in step 3, which is market conditions, news, and prospects for the company. So moving on to step number 4, we've pretty much decided this company is good, and it's probably worth an investment. It's got good prospects, its fundamentals are good, we like the cash flow, we like the news, we like the prospects of this company. Now, how much of our portfolio do we invest in? Well, that's really down to you, but I can stress here, I wouldn't YOLO in with leverage and go wholeheartedly into one stock. I see it a lot on eToro, where one person is invested into 1 or 2 stocks, 50% or even 100% or even 300% with leverage, and then they lose pretty much everything. You should never do that. But that said, there is certain situations where I'll go 10-15% of my whole portfolio into a said company. So you need to sort of work out that risk for yourself, but you do need to sort of work out what total allocation you will have. For example, Palantir. I like Palantir. I think it has good prospects, but I'm not going to put that much money in Palantir because it's not profitable and it's a growing company. Whereas Alibaba is a profitable growing company, which I think is undervalued too. And I think that Alibaba is worthwhile having a lot more allocation from my portfolio. So this is sort of down to you as an individual. But again, if you've been biased in point 3, you'll think, hang on, maybe this is worth a 5% risk, or maybe this is worth a 50% risk. But that's up to you. How much of your portfolio do you want to put in one stock? You don't really want to go in with more than 15%, 25% into any one stock. Or maybe you do. That's your decision. This is just my process. After all, I'm just a bloke on the internet with a beard. And just on that, if you want to sign up with eToro and follow one of my portfolios, the Coffee to 100K Challenge, you can sign up with eToro on the link down on the pinned comment. If you use that link, sign up, deposit, and make a trade, you get to annoy me in the chat room for life. Yes, that's right. If you use the link down on the pinned comment, then you get lifetime access to the LWT eToro chat room, and you can follow along and see all my portfolios on a month-by-month basis. But just to summarize briefly on point number 4, the whole point is to not go all in and limit how much exposure. But let's say you've decided this company is worth 10% of your whole portfolio. Should you just throw that 10% straight into it and just hope for the best? Well, not really. And that brings us on to point number 5. At this point, we are looking to invest into this company. We like all the 4 steps and we think it's a good buy. The next thing is, where do we buy? We want to put 10%, let's say it's $1,000 into this company. Where do we buy in? Do we just buy in with a market order the next day? Well, not really. That's not my process. What I tend to do is I really want to buy in as low as possible. So I would say if I was doing $1,000 into one investment, I'd try and buy in 10 slots. I'd put in alerts on my scanner. I've used TradingView. You can go and check that out with the affiliate link in the description if you wish. But they have a free scanner and you can set alerts on one company. If you download the app on your mobile phone, you get alerted when this stock falls to the price you want to buy it at. Most brokers offer this feature as well, and I don't think many people use it, and they really should. So what I tend to do is I put in alerts every 5% down, and every time the stock falls down, like look at Alibaba, it's been falling recently because of the whole China news. And I think that as this company comes down, I'm more and more happy because I'm not fully allocated. So every time I get an alert, I jump on the internet, I quickly go back through the steps. What's Alibaba falling for? Is it just because of the China news? Will it recover? Or did it kill 5 baby seals on a metro? And that's the reason it's down, in which case fundamentally, I don't like the company anymore. Is Alibaba falling? And can it recover? If the answer is yes, and the 4 steps above are still relevant, then I'm gonna go and buy some more at a lower price. And then every time Alibaba falls, I buy another $100 worth if I've only got 1,000, or I buy another 1 or 2%. I build up slowly to this allocation, and that's my 5th and final step. So all in all, that is my process. It's not that hard. If you want me to break down each step even further, I can do that if there is over 200 likes on this video. I know it's a big stretch, so go ahead and make sure it happens and let me know down in the comments. But I did promise you a bonus, and the bonus is very important. It's process. And that's the code word for this video, by the way, process. Have a process. That is the whole key to having success in the stock market. Don't go on Reddit. Don't listen to this guy on the internet with a beard. Don't listen to anyone on the internet, really. I mean, listen to them, but have your own process and your own logic, and disagree with as many people as possible. After all, it's your money, nobody else's. You can call me an idiot. I don't care. I have a process, and I pray that you do too. Because if you have a process and you stick to it all the time, eventually you'll find one that works. This one's worked for me, like I said, for over 15 years, and it's something I'm gonna stick to. Some years it's better than others, some years it's worse than others. But that is the simple fact, and the simple key to making this all stick together is have a process. Now, after all of these, is this the only steps I take? Absolutely not. I like to look at every company, especially when I'm invested in them and I'm slowly building in size. Like I said, Alibaba's falling, but I'm always researching them. I'm always looking for a reason to get out of the company. Or if I can't find a justifiable reason in terms of risk reward, then that's great. I'm staying in the company. But the key here is have the process and continue doing the process. Continue it, and you will eventually find something that works and it'll become natural to you. When I go and meet Gary from down the pub and he tells me, I'm gonna buy NEO, I go, great, what's the free cash flow? And he's sat there like, I don't know, and he carries on drinking. Or what is their operating revenue? I don't know. Well, their share dilution, I can see right now on their filings, they're actually diluting the hell out of their investors. That's not good. And you can see these people who are saying you should buy this company, they don't have a f***ing clue what you're talking about. And again, sorry for swearing, but it's quite damn annoying that they don't have a process. They did step number 3 instead of doing step number 1 and 2 first, and that is the big problem. I've been stressing on it a lot on this channel, and I know I'm getting passionate here, but a lot of people, they buy the news, then maybe look at the fundamentals, and it's completely crazy to do so. Because I'm not saying NEO's not going to do well in the future, but what I am saying right now is it's a risky investment. I mean, it's overvalued. In every way, shape, or form, it's overvalued. Does that mean it can't go up? Absolutely not. It can go up. But I am not going to waste my money on a stock that I feel from my process is overvalued. And that's what I want to get to you. So again, drop the code word down below, smash that like button, and I'll see you in the next one. And if you want to learn more on stocks, check out this video up there, and I'll see you in the next one. Take care. Peace.